An investment in knowledge pays the best interest. But when it comes to investing your own money, most people are left trying to figure it out on their own. Let's walk through 4 base knowledge points on investing so you can better understand what you own and how it all works together. Welcome to Path Financial Partners Wealth Waypoint number 2, Investments. Here we'll cover what exactly is a stock, what is a bond, then answer what ETFs and mutual funds are. Knowledge point number 1, stocks. They represent ownership in a company. Think of it like this. Imagine a company decides to grow and needs money. Instead of taking on debt, they sell small ownership pieces of the business. That's called going public. When you buy a stock, you're buying one of those small pieces, meaning you now own a part of that company. If the company grows and becomes more valuable, your piece may grow in value too. But stocks don't have an end date. They exist as long as the company exists. That's why they're typically used for long-term growth. Knowledge point number 2, bonds. They work differently. It's not ownership, it's a loan. Imagine a company or government needs to raise money. Instead of selling ownership, they borrow money. And that's where bonds come in. When you buy a bond, you're lending your money in exchange for regular interest payments. Bonds also have a defined end date called maturity. There's a scheduled date when your money is paid back. Because of that structure, bonds tend to be more stable than stocks over time. Knowledge point number 3, ETFs, or exchange-traded funds, also sometimes called an index fund, is like buying a basket of investments all at once. Instead of picking one company, you're buying a group of companies bundled together. For example, an ETF like SPY represents the S&P 500, which is made up of 500 of the largest companies in the US. You don't have to buy each stock individually. So with one investment, you instantly own a small piece of many different businesses. Most ETFs are designed to follow an index, meaning they're generally more passive and focused on tracking the market, not trying to beat it. That's one of the reasons they're often low cost and widely used in building diversified portfolios. Knowledge point number 4, mutual funds. Similar to an ETF, it's also a basket of investments. But instead of simply following an index, many mutual funds are actively managed. That means a professional manager is choosing which investments to include and which ones to leave out. For example, instead of owning all 500 companies in the S&P 500, a mutual fund manager might pick what they believe are the best opportunities. That added decision-making often comes with higher fees. So while both ETFs and mutual funds provide diversification, the difference often comes down to how they're managed and how much they cost. At Path Financial Partners, these building blocks and many more are brought together into a coordinated investment strategy within Waypoint number 2 of your overall wealth plan. So you're not just invested, you're invested with purpose, structure, and confidence. Because remember, an investment in knowledge pays the best interest. Please note, this video and its contents are for educational purposes only, not investment advice. Please consult your licensed financial professional regarding your specific situation. Thank you. Securities and investment advisory services offered through Osaic Wealth Inc. member FINRA/SIPC. Osaic Wealth is separately owned, and other entities and/or marketing names, products, or services referenced here are independent of Osaic Wealth.